Austria, long seen as a model of prosperity in Europe, faced an unexpected economic freeze through 2024 and into 2025. The country's robust social market economy faltered, with growth stalling and concerns mounting across households and businesses. 5 key challenges defined this period: a drop in GDP, rising unemployment, persistent inflation, high interest rates, and mounting public debt. High interest rates, driven by the European Central Bank's fight against inflation, made borrowing costly for both businesses and families. Meanwhile, government debt grew as spending increased to cushion the slowdown. These factors combined to create a web of challenges, testing Austria's resilience and forcing a search for new strategies to reignite growth. The story of Austria's stagnation is one of real-world consequences for industries, workers, and the nation's future. Austria's journey through economic uncertainty is a reminder that resilience and adaptation are key to overcoming even the toughest challenges. Austria's GDP told the story of its troubles. After shrinking by 0.8% in 2023, growth barely budged in 2024, and the modest 1.4% rebound expected in 2025 was still below par. The main culprit? A sharp drop in investment, as businesses hesitated amid uncertainty and high borrowing costs. The construction sector, once a growth engine, stalled due to expensive materials and interest rates, rippling through suppliers and jobs. Austria's export sector also faltered, hit by weak demand from Germany and other trading partners. As exports slowed, so did the broader economy, with European supply chain woes amplifying the pain. Private consumption weakened too, rising prices outpaced wage gains, squeezing household budgets. Even as wages rose, inflation ate away at real incomes, making consumers cautious and dampening demand. Businesses postponed projects and families cut back on non-essentials, deepening the stagnation. The result, a sluggish economy with growth and confidence both in short supply. In summary, Austria's economic slowdown was shaped by both global and domestic forces, requiring careful navigation and forward-thinking solutions. Austria's economic engine, once reliable, sputtered under the weight of these combined pressures. Austria's labor market, once a pillar of strength, began to show cracks as unemployment edged up from 6.2% in 2022 to 6.5% in 2024. Manufacturing firms and construction firms, facing fewer orders and tighter finances, slowed hiring or cut jobs. Skills mismatches left some vacancies unfilled, even as job seekers struggled. Inflation, though easing from its 7.8% peak, remained above target, eroding the real value of wages. Workers pushed for higher pay, but gains were often offset by rising costs for essentials. Businesses, squeezed by higher labor and input costs, faced tough choices on staffing and investment. The result, a cycle of cautious hiring, wage pressures, and persistent inflation. For many Austrians, the promise of prosperity felt increasingly out of reach. The interplay of jobs, wages, and prices defined the economic mood of 2024 and 2025 Austria's labor market, yet even in difficult times, Austria's workforce and communities continued to show determination and hope for a brighter future. Once resilient, now mirrored the broader economic malaise. Daily life in Austria was shaped by 2 forces: stubborn inflation and high interest rates. Even as inflation cooled from its peak, prices for food, energy, and housing stayed high, straining family budgets. The European Central Bank's response, raising interest rates, made borrowing more expensive for everyone. Loans for homes, cars, and business investments became harder to afford, slowing economic activity. Small and medium-sized businesses, the backbone of Austria's economy, struggled to finance new projects or manage cash flow. High mortgage rates cooled the housing market, shutting out many first-time buyers. While the ECB hinted at future rate cuts, the damage to investment and spending was already done. The combination of rising costs and expensive credit, looking ahead, the lessons learned from inflation and interest rate challenges will shape Austria's economic strategies for years to come. Created a tough environment for growth. Austria's economy felt the squeeze from both sides, prices up, borrowing down. As the economy slowed, Austria's public debt climbed, reaching nearly 79% of GDP by the end of 2024. The government ran a budget deficit close to the EU's 3% threshold, spending to support households and businesses. Measures like energy subsidies and short-time work schemes helped cushion the blow, but added to the debt burden. Fiscal policy became a balancing act, provide enough support to avoid a deeper slump, but not so much as to risk long-term sustainability. By 2025, the focus shifted to gradually reducing the deficit and prioritizing spending. The challenge was to withdraw support at the right pace. Too fast could stall recovery. Too slow could worsen debt. Careful management of public finances, Austria's fiscal discipline and commitment to sustainable growth remained central to its long-term prosperity, was crucial to restoring confidence and stability. Austria's fiscal response aimed to steady the ship while preparing for future growth. Behind the statistics, Austria's stagnation hit businesses and communities hard. The collapse of the Signa Group, a major real estate player, triggered job losses and halted construction projects. Industrial giant voestalpine faced high energy costs and weak demand, forcing cost cuts and production slowdowns. The tourism sector, vital to regions like Tyrol and Salzburg, saw visitors spending less and businesses delaying investments. Rising costs and labor shortages added to the strain, especially for smaller enterprises. From Vienna to the Alps, the effects of reduced investment and lower demand were widespread. Communities across Austria are working together to support each other and build resilience in the face of economic headwinds. These real-world struggles underscored the urgency for effective policy action. Austria's economic chill was felt in boardrooms, in factories, and family homes alike. As Austria looked to the future, recovery required more than just patience. It demanded action. Restoring growth meant rebuilding confidence among businesses and consumers, and encouraging investment. Policy priorities included targeted incentives, streamlined regulations, and a focus on green and digital industries. For households, easing inflation and stabilizing jobs were key to reviving spending. Strategic public investments in energy, infrastructure, and education could lay the groundwork for renewed competitiveness. Austria's strengths, a skilled workforce, strong industry, and social partnership. With unity and innovation, Austria is poised to overcome its challenges and embrace a future filled with opportunity. Remained assets to build on. The challenges of 2024 and 2025 were real, but so were the opportunities to adapt and innovate. With prudent policies and renewed optimism, Austria could chart a path back to sustainable prosperity. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.